Global fixed income markets posted gains in the first quarter, and our strategy outperformed the Barclays Global Aggregate Index on a gross of fees basis. Global growth was weaker than expected, which caused central banks, including the US Fed and the ECB, to lower their expectations for increasing interest rates. These easier central bank policies contributed to the rally in government bonds, but it also created a more favorable environment for non-government bonds, such as corporate bonds. Emerging markets also performed well, getting an added boost from rising commodity prices. This environment was good for our relative returns. Our overweight to emerging market bonds performed well, as did our overweight to the semi-core and peripheral markets within Europe. During the quarter, we made a number of changes to our positioning. We added to our duration, and we are now closer to neutral to the benchmark. Our largest country positions are an underweight to the UK due to our expectations for a soft Brexit, and overweights to the Australian and New Zealand markets. We also took advantage of the strong performance in corporate bonds to move up in credit quality and reduce our high yield position that was added at the end of 2018. We continue to be overweight emerging markets, which should benefit from central banks' bias for easy policy. This reflation bias should also drive strong returns to our overweight in inflation index bonds, which we believe don't adequately discount the risk of higher inflation. Our currency positioning is predominantly hedged into the Canadian dollar, but we do have some small over and underweight positions in select markets, with a bias toward an overall weaker US dollar. We believe that the headwinds we have seen to global growth are easing, and that with Chinese stimulus, accommodative central banks, and easing trade tensions, the global economy is poised to accelerate. As economies improve, this will lead to rising inflation pressures, particularly in the US, where we believe the Fed will resume raising interest rates later this year or early next. In this environment, we believe that emerging market bonds will continue to perform well, as will inflation index bonds. It should also be a good environment for corporate bonds, although with building inflation pressures, we expect profit margins to erode over time, and we will continue to migrate up in credit quality as spreads compress. Thank you very much for your time today and your interest in our strategy.